Okay, folks, what I want to do today is look at what happens when the market goes down and then compare that to what would happen with BTCI. Okay, a lot of people have been worried about, what happens in a bear market as it relates to BTCI. And, really, truly, it's no different than holding the underlying asset of Bitcoin, or in this case, HODL, which is the ETF that they hold. But I wanted to show you how BTCI does protect the downside a little bit more than actually the underlying asset. So let's jump right into a Google Sheets and do a quick analysis. All right, first and foremost, guys, I can't thank you enough for those that have joined the Patreon community. It really means a lot and goes a long way. We do have two tiers, $1 to $5 tier. You get access to all the calculators, and another tier, $15 a month, where you can do a one-on-one session with me per month to give you guys financial coaching and advice. With that being said, let's jump right into this quick video. Okay, so I wanted to do two simulations. Okay, I wanted to look at what happens when you have 100K worth of BTCI. Okay, what happens when you have 100K worth of HODL, which is the underlying asset behind BTCI. And this example will also hold true for QQQI against QQQ, or really any other covered call. Now, of course, there is subjectivity based on the types of out of money or in the money call structure and some of the other nuances of each covered call structure. But generally speaking, this is kind of just a rough understanding of how it all works, okay? So let's look at this. So initial investment for this example is 100K. Okay, we purchased BTCI, and the underlying asset we purchased was HODL. Okay, behind this BTCI purchase, and that's true to fact. BTCI does purchase HODL and writes covered calls against HODL. Okay, so we're assuming that the monthly price change in 1 month, this price of HODL went down by 20%. Okay, now remember, when it comes to covered calls, you aren't losing your shares. You aren't losing your asset if the price goes down. If the price goes down, you're going to earn a premium, an income, as you write these covered calls in an out of the money structure, assuming the price to go up. So what happens when the price goes down is you retain a premium for issuing these covered calls, and you retain the actual asset, the underlying asset that you issue the calls against. So in this case, while it sucks a little bit that the underlying asset is going down, you at least are able to retain a premium for issuing those covered calls. And that premium that generates is going to be about 2% per month, okay? So the average volatility and the average option cost, optionality cost, the premium cost nets around 2 to actually 4% in the market for issuing these types of covered calls. So BTCI's target objective of 2% per month is fair, right? And you can look at other statistics. You can go in the options market. You can see this for yourself that, within this Bitcoin ETF space, the premiums are in and around 2 to 4% yield per month. And you can look at other competitors. This is kind of common knowledge today. So let's just hold that to be true, okay? And I can share some documentation on that. But anyways, okay, so let's look at scenario one. Let's assume you just own Bitcoin or HODL, right? Bitcoin, HODL, in this case, kind of the same thing. HODL owns the spot Bitcoin, all right? So you own HODL, and the initial value there was 100K. You purchased it for 100K. That value went down by 20K. So your end value at the end of the month is 80K. Simple, right? Okay, guys, in scenario two, we are owning BTCI. We are purchasing BTCI, okay? And with the initial value, it's the same as HODL. We're gonna purchase 100K worth of BTCI. And as I spoke on the Bitcoin yield, the BTCI yield, again, from the options market, that we can generate is gonna be 2% of that initial value, so to 2K effectively every month, okay? And the capital loss, so because we didn't gain anything on this trade. We are still only holding and owning the underlying asset of, in this case, HODL. So just like in scenario one, our value will go down by 20%. So we'll lose 20K on this trade because, again, that value went down just like in the HODL example. All right, but the difference is this. The difference is we made that extra $2,000 due to setting up that covered call, right? What happened again is we set up the covered call, we issued that covered call, that allowed us to unlock this premium. Because we were issuing the covered call, we unlocked this income effectively for issuing that, And because the asset did not hit its strike price because it went down, we're going to effectively take a loss but retain our assets. So in a sense, we're going to retain our assets and we're going to gain a little bit more than we did on HODL because we have the extra 2K. So ultimately, in this 1 month, just hypothetical example, holding the underlying asset of HODL is going to net you the negative 20%, but BTCI cushions the blow a bit, and the loss would have been 18%. And I've kind of mapped out this example over a longer period of time, where 1 month you own HODL, if it went down 5%, it'll go down a little bit more due to the expense ratio, so 94K. Second month, 90K, third month, 85K, fourth month, 81, all the way down to 72K for a total loss in this case of 37%. Okay, and that same example, we can look here at BTCI. Because of that extra income we're adding every month, and while it does have a higher expense ratio, I factored that into this example, but because that extra income, it's cushioning our blow. Okay, it's cushioning our blow so that, we have less negative return. So in this case, it's a negative 36% return as opposed to a negative 37% return. So ultimately, we don't want these assets to decline, but when they do, the covered call scenario, the covered call product will cushion the blow and reduce the volatility for your investments. Okay, looking at the results over the past year and bit, from when BTCI has come out, we can do this example. We in this example, we're using Testfolio, and we added here 10K, okay? And again, this is not just rolling all the way down. This is an example of actually what happened in market, okay? So from 10K, the ending value was 16K on HODL and 15.6K on BTCI. So of course, holding the underlying asset is generally more favorable for capital appreciation. That goes without saying. But BTCI was still very strong at 15.6K at a 56% return, and HODL did 67% return. But in terms of cushioning the blow, let's talk about that, all right? So HODL, the max drawdown was negative 28%, whereas BTCI was negative 24%, okay? So in terms of its drawdown potential, we're seeing that the underlying asset in this case draws down further than that of BTCI, and its volatility. It's much more volatile. You can see a 46% volatility here versus a 38% volatility. They're actually both very volatile, but the underlying asset in this case is showing a lot more volatility, whereas BTCI is stripping that volatility out because of its income generation, even on the way down and even on the way up, right? We're gonna see less volatility and less drawdowns and less up spikes as a result of the income generation. Hey guys, what did you think about this analysis? I know it was quick and simple. I will leave this Google Sheets in the Patreon. Please guys, comment below, subscribe to the channel. All the best and cheers.